Chris, we should start actually by pointing out your performance. It's actually been really good for the 12 months ending June. If we can talk about the previous year, and then we'll get into the challenges. The previous year first.
Well, it was a strong year, but I don't look at 1 year. It's a marathon, and so 1 year is just the pace per mile over 20 years, and I really have to look long term. With a booming economy, last year was a great year, but now what about the next fiscal year? And it's going to be a challenging year.
9% for a 12-month period. What are your basic assumptions going forward? You say this is a challenging year. What are the basic return assumptions right now?
Picture a pension plan is a lot like a cruise ship out in the ocean. The board's picked a spot on the horizon. Yep. We're going to steer toward it.
What's the spot?
The spot is 7% all the time. And in fact, every time we inch closer to the horizon, it just keeps moving out. We're not going to come into harbor. So we're going to stay long. We're going to be exposed to equities, stick to our asset allocation, and we're going to hedge the portfolio periodically when we think rough seas are ahead.
I have to think that a lot of pensions are looking at that 7% horizon, 7.5% horizon at a time when benchmark 10-year Treasury yields are below 3%. And they're thinking, I have to invest in private equity. I have to invest in companies that I might not otherwise invest in. I have to invest in emerging markets because there's no other way for me to get there. And I have to wonder about the risk that's building as a result of that when the tide does wash out. If we do have some kind of downturn, wow, they're not going to meet their bogeys.
Well, when I look at it over a 30-year period that I've been in the business. We started at a 70-30, we being the industry, an average 70-30 asset allocation. Then they went to about 75-25. Now most pension plans are 80-20, and they went that back when interest rates went to zero.
80 equities, 20 bonds.
Thank you. Now we're looking at the fact that, hey, on the other side, hey, yields are up to 3%. Now fixed income is going to have a return. You actually may see people take a little risk off, even though it seems counterintuitive.
So you're optimistic. You don't think there's too much risk that's been taken out there?
I think that a 7% return over a 30-year period is a realistic assumption for us. There are still plans that are up at 8%, a few that are going lower, but I think we can average 7% pace over 30 years, not in the next 12 months every time, but over a 30-year period.
We've got cycle highs at the front end of the Treasury curve, and I think for some investors cross-asset, that might make a difference. Does that really make a difference to you? Approaching 3% on a US 10-year, in and around 2.5 at the front end of the curve. Does that really move the dial for a big pension fund?
It does, but you know what's interesting, not just in fixed income. What it's doing is it's actually bringing in risk and a risk-free rate, so that we're seeing, hopefully we'll start to see more realistic pricing in real estate, in private equity, and the other asset classes. I think we are in an abnormal state with zero interest rates, and I'm glad we're finally getting back to what we might consider normal.
You brought up PE, your best performing asset class in the last 12 months, and you're starting to think about doing some interesting things. Can you walk us through the strategy around private equity for your fund?
We've got our private equity portfolios predominantly in partnerships. And what we want to do is diversify that into co-investments and maybe some collaborative exchanges with other funds where we buy and hold companies. I think a longer-term model, technically private equity at 14 years is actually short-term for us. We'd rather be in investments that we could hold for an extended period of time. I call it core or private capital investments, and I think you'll see that grow in the next 12 months.